Good morning and welcome to the last day, the fifth day of the LuxFLAG Sustainable Investment Week 2021 edition. I'd like to start though by taking a moment to thank you all for your support during these difficult months since the tragic passing of LuxFLAG's general manager, Sachin Vankalis. Sachin was a great human being and a tireless supporter of sustainable finance. And he exemplified LuxFLAG with his passion, ambition, and drive to move to a sustainable future. So thanks so much for your support. As chairwoman of LuxFLAG, I'm pleased to see that after two editions, the LuxFLAG Sustainable Investment Week has already gained recognition, and that's really thanks to LuxFLAG's associate members who are showcasing this week where they are in the sustainable finance journey. And as the financial industry is on different stages of that journey, this week is about sharing best practices so we all advance towards the goal of making all finance sustainable. For this third edition of the LSIW, we thank you for such a fantastic response with over 3,500 registrations over the week. I'd like to thank our host partners and media partners for helping to make that happen. 25 sessions over the week have covered and will continue to cover this morning the latest trends and most pressing issues in sustainable finance, which we hope you find useful, instructive, and inspirational in terms of helping you make progress to harness finance to find solutions to today's environmental and social challenges. I have a few housekeeping points. First of all, the slides and the recording of the sessions will be made available to you in a week or so. And please do ask questions. For the Q&A, please use either the Q&A function, which has not been working consistently, or put your questions in the chat, and we will take care of those and hopefully get to all of those questions. So first of all, I'm pleased to introduce today's first session hosted by FARAD Investment Management. And today's topic is the challenge of ESG reporting, which is obviously a challenge that is coming up soon for all of us in the asset management industry. I'd like to introduce the moderator of today's panel, Gianluca D'Alessio, who's Senior Portfolio Manager at FARAD Investment Management. So Gianluca, the floor is yours. Thank you.
Reporting. But first of all, which is the idea behind this panel session, and which is the core targets of this session? In the current context of absence of a clear taxonomy and of the lack of availability of ESG data disclosure, it is crucial for investors to be able to collect, identify, and understand the most relevant sustainable metrics which impact their portfolio. In this context, at FARAD Investment Management, we are actively engaged in the transition to a more sustainable way of doing business within the investment management industry. In that context, we develop our own scoring system called Greenetica Sustainable Scoring System, in which we tackled some potential solution in the context of the current challenges of ESG reporting, particular thanks to the alignment, to measurements of the alignment of the portfolio in the 17 Sustainable Development Goals by the United Nations. In this panel, we will provide you two different views from the main actors from the main side of the ESG reporting, meaning the data providers, which are required to collect the data and to check the consistency, the reliability of ESG data. And on the other side, the investment managers, which are constantly increasing the ESG data inclusion within the decisional steps of the investment process and are required to produce the final ESG reports for the clients. In that perspective, I would like to introduce you the three panelists of this session. Hortense Bioi, Global Director of Sustainability Research at Morningstar, Eli El-Kadi, ESG Client Portfolio Manager at Candriam, and Jeremy Kent, Senior Portfolio Manager, Sustainability Equity at NN Investment Partner. I would like to start with you, Hortense, and I would like to ask you to give us a quick review of which are the main challenges you experienced within your company in the ESG data collection, and which is the evolution you see in the market in the last 2 years in terms of data disclosure. Thank you.
Thank you very much, Gianluca, and good morning, everyone. It's a pleasure to speak to you today. So yes, my section is on ESG disclosure. If you move to the next slide, an improving yet incomplete picture. I'm not sure that's the right deck. Do you have the right deck?
Perhaps you could start or test with your discussion, and then we will try to fix this
Okay.
technical issue.
Okay, sorry
Thanks.
about that. So I'm going to talk about both corporate disclosure and fund disclosure. So environmental, social, and governance factors are viewed as material by more and more investors and are now a must-have in the investment process. Asset managers are increasingly dependent on reliable and consistent data being available from their investee companies. And more companies are disclosing non-financial data. But unfortunately, there is currently little to no consistency across these disclosures, and information is not easy to consume, let alone compare across different businesses. So back in June, Morningstar and Sustainalytics, a Morningstar company, published a global study on corporate ESG disclosure. We looked at the disclosure rates of various types of corporate ESG indicators across regions. And we found that while disclosure is trending in the right direction, it remains far from ideal. The current status is shown so on the slide you'll see in a minute. As expected, European companies are setting the pace with disclosure rates approaching 76%, followed by the United States at around 67%, and Asian companies lagging, disclosing an average as little as just over half of the indicators. And this is measured by the Sustainalytics company database across the 160 indicators used in the ESG risk rating. So this doesn't include impact focus metrics. The headline numbers, though, mask varying pictures when looking at specific topics and industries, which is what we're going to see in the next few slides. Is it possible to put it up or?
Hortense, if you could switch to your user and you can show directly the slides because I don't have your final slide deck, please.
That's actually going to be difficult. I don't I'm not sure I'll be able to do that. Should I send it? Maybe we can ask another speaker to speak first and then.
Okay, so
I send you my slides.
This is the
again
the funny step of being live. So perhaps I will switch directly to Eli Al-Kadi with the second panel of this session, and then we'll come back to you later on.
Yeah, I think that's probably best. Thank you.
Thank you. Eli, could you please give us your view in terms of the challenges you faced at the investment management side in collecting the data and retrieving and making them comparable between the different area, between the different providers you faced? Thank you very much.
Sure. As said Gianluca, my name is Eli Al-Kadi, and I'm the client portfolio manager for the ESG department at Condriam. So during my presentation, I will explain you first why at Condriam we tend to use exclusively raw data to feed our ESG research platform, and what are the biggest challenges that we may face. Then I will develop on how to select a proper external data provider, especially for dedicated non-financial information. And then I will discuss a little bit on what could be a proper solution to tackle these ESG reporting challenges. So if you go on the next slide, so many challenges face investors who are choosing an ESG ratings provider because there are different types of providers first available, and there is a lack of correlation and consistency in the ratings produced by the different providers. So as you can see on this slide on the right side, even well-established providers, MSCI, Sustainalytics, FTSE, with robust methodologies can assign different ratings to the same company. And this is a result of different methodology. For instance, one rating provider may place, let's say, a greater weight on a particular metric versus another. And some metrics might be, let's say, included by one provider, but not the other. So it really depends on the provider's algorithm, for example. Another point to highlight is that Sustainalytics, for instance, scores company on the risk scale, meaning that a lower score is better than a bigger one, while MSCI scores company in the opposite, which clearly demonstrates different methodology across data providers. And this is the reason why at Candriam we decided to exclusively use ESG raw data from different data providers to feed our proprietary ESG model, and to come up with a truly independent point of view based on objectives, extra financial information. So by doing so, we make sure to avoid any bias towards any provider's point of view. So on the slide that you can see, I try to select what is, in my point of view, the biggest challenges that asset managers might be confronted with, even though they might be more than what is shown on this slide, obviously. But first, one of the biggest challenge, obviously, is the availability of the data. It's true that most, let's say, developed traditional markets have shown significant improvement in terms of extra financial information, but there is still a lack of available data for emerging markets, high yield, small and mid caps, because of different legislation, different resources from companies, because as you may wonder, large caps companies have more human resources compared to small caps, for example. A second example would be the reliability of the data, especially when we talk about estimated ones. So you might wondering which methodology the data provider use for estimated figures, and does it properly reflect the reality of a company by doing so. And finally, one of the third challenge, we need to make sure that the data are consistent from one period to another. So to do that, you need to implement a data quality check to avoid any misleading action. So for instance, if you download the latest data for a particular figure, for instance, the carbon emission, and you discover a jump, let's say the score double, well, you might sell the position due to these updated figures, but it might be an error. So it could be either a problem of the carbon emission figure coming from your data provider, or a problem in terms of, let's say, enterprise value from the financial data provider. So you need to make sure that the data you get from your data provider is correct and consistent over time. Otherwise, you will make unnecessary action towards your portfolio. On this slide, so the ESG landscape is really characterized by a large number of ratings providers offering a very wide array of data, from specialized providers that calculate metrics on specific ESG aspects, such as carbon score and gender diversity, etc., to providers that rate companies based on several hundred of ESG-related metrics. So knowing where to start when evaluating data providers is really necessary. And no single source of or directory offers a clear, comprehensive overview of data providers. So to assess which data provider to rely on, you may establish a scoring framework to select the most appropriate external data provider for specific extra financial information, such as environmental related metrics. So for instance, when we look at which data provider would be most suited to calculate our portfolio temperature, We assess each data provider's first methodology, its coverage ratio, the resources implemented, the output quality, which is really important, and the format, and the ease of implementation within our internal system, because in order to properly implement in an, let's say, automated way, all the data on a monthly and quarterly basis, you need to make sure that there is an ease of implementation of this data. So you may certainly use different data providers depending on the key metrics you try to assess. That's why we tend to use TrueCost and recently Carbon for Finance for any environmental data metrics, while using Sustainalytics MSCI for any let's say controversy or social aspects, etc. So it really depends the expertise of each data provider. On the next slide, so what's the most challenging about sustainability focused investment analysis is that the company's sustainability disclosures need not conform to share standards in a way their financial disclosures must. And I think you will all agree that one solution will be to develop a standardized ESG reporting standard, especially across different regions, from developed to emerging markets. That is really necessary. And I think it will certainly promote consistent and comparable sustainability disclosure, and will ultimately be the starting point to audit and gives assurance on all disclosed extra financial information, which is vital for any investment decision. That's it for my part. Feel free to drop a message if you need more clarification. And
thank you, Eli. I have a first question for you. You briefly mentioned the challenges in collecting the data for high-yield segments. What about the producing the ESG reporting and collecting data for a global bond-oriented portfolio? Because nowadays the availability of data are more focused for companies and stocks, while for bond-oriented portfolios there is still a consistent lack of availability of data. Which are your experience on that? Thanks.
Yeah, that's true. Thank you, Jennifer. That's a really good question. Actually, in the fixed income space, the main challenge first that come up in my mind is the mapping system. You know, when you map all the bonds, you have the issuer, and it might be also the parent company. So you need to first really correctly map into your system the bond that issuers are in your portfolio. So you might get a lower coverage ratio if you don't have a proper mapping system. And again, some companies, some affiliates doesn't have any data, so you need to make sure to sometimes take the parent company data if it's not available. And then when we talk about fixed income portfolio, you may have govies, the sovereign part. So
exactly, that's one of the most tricky part.
Yeah, a colleague just told me yesterday. By the way, it's a real coincidence. What does it really make sense to calculate a carbon emission of a portfolio that have more than 50% of govies, meaning that you only have at the beginning only 50% of a portfolio that might be covered in terms of carbon emission? And that's one of the biggest challenge, because you basically you cannot calculate the carbon emission of a country compared to a corporate. That makes more challenging. And one of the most difficult part here is we cannot select different impact indicators depending on the strategies. Because of the lack of available data, we tend to use, let's say, general impact indicators for all of our strategies, but maybe in the future, we might select, let's say, impact indicator depending on the strategy. But usually for the govies part, we try to implement dedicated impact indicators, such as the Freedom House Index, the Corruption Index, the Paris Equity Check, and you have also the temperature of the countries, the alignment of the countries for the Paris Agreement. But again, you need to automate everything to map correctly everything into your system and diffuse really key impact indicators related to a particular strategy.
So does it mean you don't collect the data regarding of the country in terms of the focus of the GDPs in the different sectors? No.
For the moment, we don't use data provider for sovereign parts. We use non-profit organization to collect specific data for countries. But we all the automated data that we get from that external data provider are only for corporates for that moment.
Okay, thank you very much, Eli. I will come back to you at the end of the panel with a common question to all of the three panelists. Thank you, Eli.
Sure.
Then we can move to Jeremy. Jeremy, could you please give us your view in terms of the main ESG challenges, the challenges you faced at an investment partners in producing ESG reporting within the equity part? Thanks.
Thanks, Gianluca, and hello, everyone. Yeah, so as Gianluca said, I'm responsible for managing our global and European sustainable equity portfolios, so intend to go through some of the practical challenges that we've had in identifying and reporting on ESG performance of our equity strategies. And if we go on to the next slide, Gianluca, just as a brief overview on the areas I intend to cover at a pretty high level, but hopefully we'll bring in some examples to bring it to life a bit. But these sort of four practical considerations that I'll touch on are one, ensuring alignment with the investment process or approach. Two is external comparability, and really this is touching on indicators that may be relevant for the process, but ultimately lack external comparability. And then specific comparability being what's already been touched on, the sort of non-standard nature of company-specific reporting, which can lead to a set of challenges in aggregate reporting. And then finally, the challenge of acting on the reported ESG data. So rather than just having reported data, actually doing something with it. So if we turn to the next slide, and this is really touching on the first challenge that I noted, being the alignment of the ESG reporting with the investment process. And I think this area is oftentimes overlooked and can be driven by regulation or client demand rather than what's actually going into the process. And it's kind of the wrong way of thinking about it if that's what's driving your ESG reporting, in that it's likely coincident rather than by design the sort of output of the portfolio. So important for the inputs to be considered. But if I go through each of the bullet points, I'll actually start with the second bullet point there being objective related. And this can be relatively straightforward if the ESG objective is specific and tangible, such as something like trying to achieve low carbon intensity or other quantitative figures. But oftentimes objectives can be fairly vague. So, trying to demonstrate low environmental impact or just seeking companies that do well on ESG. So the challenge here is really having a specific objective or a specified objective with a sort of tangible output that can be demonstrated. The first bullet point here is really touching on taking the inputs from the investment process. So I've laid out our sort of simple flow chart of the investment process that we have for our equity portfolio, and really what's important is pulling out the individual inputs into the process. So there's a number of touch points within the investment process, from the ESG screening, where we have a proprietary ESG score that helps build the investment universe, through to the fundamental ESG characteristics that we're looking at on a case-by-case basis. And then finally, around the active stewardship, so the proxy voting as well as engagement of the company. Again, key inputs into the process that we should be able to demonstrate on the outputs. And the last point that I make here is bringing those first two together and really just making the point of intentionality of the reporting that's being done and the indicators that are being used. If these indicators are feeding into the inputs of the process, then there should be some element of intentionality of what these look like as you report them. So yeah, these three aspects really on sort of deciding which indicators are most appropriate for the specified investment product. The second element that I'll touch on is on the next slide, and that's external comparability. And again, this is touching on a point that may be very relevant to the individual investment process. So here I've highlighted our proprietary ESG score, the NNIP ESG Lens score. Much like a lot of other ESG scores that are created, it starts with a materiality matrix from an ESG perspective on a sector-by-sector basis and pulls in external data to produce an overall ESG score. Which is great from an internal process. It's heavily used and really helps us in building our investable universe as well as assessing companies on a stock by stock basis. However, the challenge comes from the external comparability point of view, where obviously this isn't going to be shared across investment managers, and it presents a challenge to those looking from the outside in on assessing what this looks like. So really the point here being that this can only be sort of one element of the ESG reporting and not the be all and end all. So there are going to be elements that are perhaps specific to the investment process, but not externally comparable. But there needs to be that balance of both, and that's where I guess before turning on from there, I guess one point to make is this isn't going to go away either. And I guess referring to SFDR regulation, for example, each investment manager is going to have to determine what is a sustainable investment and what that looks like, and the spread or the approaches that each investment manager is going to take is likely going to be relatively wide. So that challenge of comparability from manager to manager is a real challenge. So you've got to understand what's going into those ultimate scores. I suppose one possible solution to this is providing more specific indicators, which I touch on the next slide. But as has already been highlighted, this brings about its own challenges. And here I highlight one of the specific indicators that we like to look at when we're assessing companies, and that we also report on for our portfolios, being the lost time incident rate. So the number of injuries within a company for a certain amount of hours worked. It tends to be a good indicator of quality from the sort of health and safety aspects of a company. Certainly for manufacturing companies, this can be a material issue. But for other companies, it can also be material as you look at it. The pie chart that I show here gives that demonstration of the challenges with the availability of data. So the pie chart is representing the MSCI world and the companies that have data on this and don't have data on this. And obviously you can see that it is relatively limited. So, there's still some work to be done here, some improvement to be had. It is improving slowly over time. But when this data is reported, you have to take it with a bit of a pinch of salt in that perspective. The second aspect of the specific comparability that I was going to highlight was around the commonality of reporting for companies, and here's two examples of companies in different sectors that from our perspective have very good safety reporting, but it's very specific to the underlying sort of nature of the work that's being done. So for example, for the technology company, it's perhaps a little bit difficult to read, but a lot of the injury reporting is around some of the more office related injuries that may happen while at work. and gives great depth on that side of things, but less depth on other aspects. And you can see that demonstrated in the industrial company, where this company again has very good safety reporting and captures elements like near misses, which aren't often caught in elements like the lost time incident rate, but can be an important aspect. So is a challenge to sort of compare reporting from company to company, in addition to the lack of availability more broadly. The last aspect I'll touch on is the use of reporting, and you know, it's great to have some ESG reporting and demonstrate it, but once you have the reported data, you know, sort of, so what can you do from that stage? And the primary use of reported data that I'll touch on here is utilizing it for engagement with companies. And I think the key challenge that comes about here is really the time required to one, analyze and assess the individual corporate performance on some of the indicators, but then also just delivering the engagement with companies. You know, we have the benefit of having a relatively concentrated portfolio for the ones that we manage, so are able to have this high touch engagement with the companies that we look at. I've stuck with the lost time incident rate here, just to flesh that out a little bit more, and how we sort of drive that through. And so you can see on the left-hand side the aggregate reporting. So at an aggregate level, the portfolio looks decent versus the benchmark. However, when you drill down into the sector level, you can see actually there's a couple of outliers where the portfolio perhaps has higher injuries than the underlying universe, and that's the area that's you know, we want to assess and get to grips with on why that is, and ultimately what we can do about it. And that's where on the right hand side I've blurred out the company name, but this individual company is responsible for the high injury rates within the consumer discretionary space. So we want to understand why that is. One, the activities that its employees are exposed to tend to be a little bit more injury prone than the consumer discretionary space. So, you know, they're not an apparel retailer that's has their employee base standing behind a shop till. They operate machinery, so that's one explanatory factor. Secondly, looking at the trend over time, and you can see it has come down pretty significantly over the last 5 years, which is great. However, you know, the injury rate remains high, so that's when we then bring in the engagement and go to the company and see what they're doing, and perhaps encourage them to improve the safety performance over time. So I'll stop there, Gianluca, and hopefully that gave you a flavor of some of the challenges.
Thank you very much, Jeremy. Perhaps a quick question regarding the collection of consistent comparable data you experienced among the different geographical area you are covering, meaning were you forced not to invest in particular companies merely due to the lack of data, or how did you face these issues? Thanks.
Yeah, I mean, that's certainly the case, and perhaps using the ESG lens as an example, you know, where there's a lack of data, the companies do get penalized for not having that data. And for our global portfolio, you know, it's global sector relative. So it is comparing an industrial company sat in Europe versus that in the US and in China. So there's no doubt that there is you know, some penalty, let's say, for lack of reporting, as well as just generally poor performance. But that's something we're relatively comfortable with, in that, you know, that lack of reporting or perhaps poor performance is a reflection of you know, poor underlying quality in our view. So you know, it's an area where hopefully again the engagement efforts can help with improving the reporting from those companies, understanding of issues that may not be reported by the company externally. But again, that dialogue can flesh out some of that, but undoubtedly is certainly a challenge of underreporting across various regions.
Thank you very much, Jeremy. Now we'll try to come back to Hortense with his presentation. So Hortense, I leave you again the floor. Thank you very much.
Yeah, thank you, Gianluca, and sorry about that again. So maybe we can move to the next slide. I was talking there about the different regions. That's the current status. As expected, European companies are setting the pace with disclosure rates approaching 73%, followed by the US at 66%, and Asian companies are lagging, disclosing on average just a little bit over half of the indicators. So this is measured by the Sustainalytics company database across the 160 indicators used in the ESG risk rating. So this doesn't include impact-focused metrics. So the headline numbers, however, mask varying pictures when looking at specific topics and industries, which is what we are going to see in the next few slides. So next slide, please. So as expected, also environmental disclosures are more common than those relating to social indicators, and this is true in all regions. So with broadly consistent levels of disclosure across the different types of indicators. Focusing on the most widely applicable environmental indicators, besides two that have near universal disclosure, so it's environmental policy at 97% and environmental management system program at 97% also. We're seeing, however, that the next most material indicators see much significantly lower disclosure rates, as shown here, especially outside of Europe. Unsurprisingly, considering the EU's established Sustainable Finance Action Plan, Europe leads the way there as well, while Asia significantly lags in these areas. Next slide. When it comes to social considerations, two of the most material indicators, so human capital development and discrimination policy, see more than 90% of companies disclosing. The third area in which close to 90% of companies regularly disclose some data is workforce diversity programs in response to growing investor interest. So for example, shareholders have submitted many resolutions over the past decade requesting information about board diversity, indicating their interest in using it to assess corporate governance. Gender pay, however, which Sustainalytics consider material to over half of companies, have the worst disclosure at only 20% globally. The firms with a good disclosure are predominantly European, although there are only 34% of them that disclose that data. This is indicative of existing regulatory requirements in individual countries like the UK and Spain, but there is no regulatory requirements at the EU level. Next slide, please. In the governance area, there are more indicators that are material to substantially all companies, three of which are reported on by over 90% of companies. So that's ESG governance, bribery and corruption policy, and whistleblower programs at over 90% for each of them. At the other hand of the spectrum, the indicators shown here are disclosed by far fewer firms. The US and Europe are where more companies disclose a political involvement policy. The lobbying and political expenses indicator highlights the proportion of companies that are making political donations and or that actively lobby. It's most prevalent among US companies because it's a legal requirement to disclose lobbying activities as part of the Lobbying Disclosure Act. And in other regions, disclosure is very low. Next slide, please. So what did we conclude? Because that was taken from a study that Morningstar and Sustainalytics did back in June. What we concluded from the disclosure analysis of various material ESG indicators, we concluded that disclosure rates are certainly improving, but we still find that companies only disclose on about 2/3 of material topics. Regulatory mandates improve consistency, quality, and completeness of disclosures, and would not be placing a huge new burden on many companies given the progress that has already been made. Individual country regulators are helping, but most benefit will come from coordinated international disclosure rules. Investors will have to continue to digest a hodgepodge of non-comparable data for as long as different countries apply different rules, and companies can cherry pick how to disclose non-financial metrics. Companies will disclose the good and hide the bad, while disclosure remains voluntary. Materiality is key to ensure the most important information is available to investors for each industry. A small core set of consistent metrics, so published by a company of any size in any industry, we think would create the starting point for a level playing field for companies to be assessed by investors. Next slide, please. Now, moving on to ESG disclosure at fund level. This is an area that I'm probably more familiar with, given my role at Morningstar. I'm part of manager research. Over the past couple of years, I've seen an evolution in the way asset managers disclose ESG information about their funds. There is currently no standards, which result in various reporting practices. There are still asset managers that provide zero ESG information to investors on their funds, including ESG focused funds. Others, like this one, provide very high level metrics, like in this case, the fund's MSCI ESG rating, and where the fund's quality score ranks in the peer group. You can also see here the fund's carbon intensity. Although here, since it's not even compared to a benchmark or a peer group, I'm wondering how useful that really is. The next slide, please. Other managers offer more disclosure, especially on carbon. Here you can see the fund's greenhouse gas intensity compared with that of the benchmark. You can also see the historical evolution of that carbon intensity, as well as the sectors and companies contributing the most, and also relative to the benchmark. Next slide. Now, there is other and more innovative way now to disclose a fund's climate profile using temperatures. This is, of course, even more relevant in the context of achieving net zero by 2050. This is a portfolio that is on a 1.9 degrees Celsius trajectory compared with 3 degrees for the MSCI World, so comparing the temperature of the portfolio with the benchmark. Right now, the fund has a carbon footprint that is 36% lower than the benchmark. And the target of the investee companies is to reduce their carbon emissions by 43% versus an increase of emissions by 3% for the MSCI World. And you can see at the bottom, the top 5 and bottom 5 holdings with their temperatures and carbon footprint. So that's it looks quite slick to me. Next slide, please. And this is my last slide with SFDR. As we all know, asset managers will have to disclose a flurry of new data points, including in the case of Article 9 funds, the alignment with the EU taxonomy. And this is what the reporting could look like, with a lot of detailed information about the composition of the portfolio, showing the percentage of the portfolio that is aligned with the taxonomy, not aligned but eligible, and not aligned but not eligible. Sorry, not aligned and not eligible. So it's very detailed. And again, you can see at the bottom the biggest contributors in terms of alignment. That was my last slide.
Thank you very much, Hortense. Perhaps a quick question for you from the audience. How do you deal with data gaps for private companies? Could you give us some details about that? Thanks.
Okay, so Sustainalytics only only covers listed companies. So yeah, very straightforward question. Like I think we cover 16. We have data for 16,000 listed companies.
Then I will pose the same question
And
to
we
Ellie
and
Jeremy.
we. Sorry.
Then the same question will be also for Ellie and Jeremy, please.
Yeah, I mean, I'll go with the same excuse there in, in that we invest in listed equities. But I mean, I think it's similar where there's data gaps in listed equities, in that ultimately it's got to be done through engagement with the companies itself, and you know, that's how we tend to fill in the gaps where there's missing information that we want to see from companies, be it public or private.
And as Jeremy, I think, mentioned, or maybe it was Ellie, we yeah, wherever there are gaps, Sustainalytics estimate the data, right? So they take I won't go into the details, but they look at, for example, industry average, and depending on the region where the company is based, they estimate the missing indicators for a company.
Well, at Cadriam, what we have done recently, by the way, for private companies, because we have a partnership with an external company that invests in private companies. So we've built a questionnaire, a tailor-made questionnaire that lists all the questions to get the information or the data to feed our model. This is freshly new. I have no idea if it works, but we send this questionnaire to few companies. I haven't seen the result, but I hope it will be promising. Yeah, that's our solution to, you know, to get the data if the data provider cannot give the results.
And I think also it's important to understand that company disclosure is, I mean, only one source of data that is collected. We collect data from many other sources, including open sources. You know, the internet. We have NGOs. Now you have like satellite images that can be used, you know, to not only collect the data but also to check the accuracy of the data. So with the help of technology, certainly going forward, you know, ESG data providers will not only continue to rely on this company disclosures, but many other sources. You know, we know that with blockchain as well, we will be able to collect data from the most remote areas of the world, and that's mostly relevant for impact investing, when you want to know really what the impact of a certain project or investment would have on local communities, for example.
Thank you very much. I believe that after this panel session, the major issues we identified in the challenges for the ESG reporting are the lack of a common framework and the availability of data disclosure, which are not yet comparable among the different areas and among the different asset classes. I have a final question for each of the three panelists. Don't you believe perhaps a potential solution could be to measure the alignment of the portfolio and the business of the portfolios towards the 17 SDG goals, and to try to concretely measure the positive impacts of the portfolio with the alignment to these SDGs? Thank you.
Yeah, so this is something that Sustainalytics is developing, and that's data we'll make available to our clients early next year. So so even for funds, we'll be able to show investors the alignment of the portfolio with the 17 with the SDGs. So we know that you know, the focus so far has very much been on material ESG risk, but investors are increasingly interested in really the impact of their investments, or positive and negative impact of their investment on the world, and they know really the alignment with the SDG. Alignment doesn't necessarily mean impact, right? I mean, as in it's not because you're investing in these companies that you are going to make an impact. Owning an impactful company doesn't necessarily mean make an impact in the world. I think there's going to be some education also to do with investors, how they should interpret this data.
Thank you very much, Hortense. Ellie and Jeremy, a quick comment from your side, because we are pretty short of time. Thanks.
Yeah, I guess, I mean, quickly from my side, I think, I mean, it does provide a nice framework and sort of common language for reporting on issues. However, coming back to the point that I made earlier, there does need to be some level of intentionality from the investment manager as well. So I think, you know, in order for an investment manager to report it, you know, there should be some level of intentionality in trying to gain exposure to these. Otherwise, it's again by coincidence and not necessarily genuine, the exposures that'll be there, and can be quite volatile over time as well. So I think that is perhaps one challenge to, you know, standardize the reporting in that way.
Thank you,
From
Jeremy.
my side, yeah, from our side at Candriam, we already report on SDGs in our sustainable fund fact sheet. We use another data provider of Sustainalytics or MSCI, but I'm pretty curious which methodology will Sustainalytics will bring live and see the difference with the data provider, because, you know, as I said during my presentation, each data provider have its own methodology, so there might be some gaps, and maybe if there is a consistent framework to calculate the SDGs plus information coming from companies, it will be very helpful.
Thank you very much, Ellie, and thank you to each of the three panelists which supported the success of this panel. Thank you very much.
Thank you.
Thank you.
Great, thank you all. Thanks, and on behalf of LuxFLAG, I want to thank you all a lot. I mean, I think that, you know, clearly we know that data, along with everything sustainable finance, is evolving, and obviously there's huge pressure to have it evolve quickly. And clearly as well, we rely also on what's happening at the regulatory level too, with the corporate, the CSRD coming up, and yet so really it was a great session, and I think the level of detail as well that you went into in terms of some examples, and also the use of data for engagement, I thought was really interesting and really helpful. So thanks very much, and thanks again to FARAD Investment Management for hosting this session. A big thanks to the LuxFLAG team for making this happen. And finally, I'd like to end this session with a quote that I hope will resonate with everyone. We now understand that sustainable finance is not just another type of investment, it's a complete shift of mindset. Lots of work to do. So our next session will start at 10, hosted by Micro Capital, where we will discover impact investing opportunities along the Silk Road. Again, thanks very much, everyone, and have a great day.
Thank you.
Bye.
Thank you. Bye-bye.
Bye, thanks.